Good evening, participants. Thank you for joining another Open House webinar. Today's topic is Awareness for Delta Equivalent Open Interest. Today's topic is primarily towards informative awareness on a concept which we thought can be helpful to all the market participants. During today's session, we shall be touching upon nuances related to the topic. I am Jwalan Gandhi, and with me today is Aniket Bhanu. So before starting the discussion, let me remind participants that all the earlier open house webinars we keep uploading over NSE's YouTube channel under the playlist which we have created as NSE Open House Sessions. This particular webinar will also get uploaded in coming few days. So in case somebody is not able to attend today right now, they can refer the webinar later on through the said path which I have mentioned for the NSE's YouTube channel. So let us start without a further ado. Aniket, if I may request you to first provide a conceptual overview to our participants, please, about the delta equivalent open interest.
Yeah, sure. Thanks, Jolan. So, as everybody is aware, we have been publishing open interest since the launch of derivatives, so that's more than 2 decades. But now our derivatives market have become really active, and customers don't trade in a single product like futures or a particular option anymore. Customers trade in a range of derivative products. So, for even if we take a stock or a particular index, for the same for a given product, we will have multiple expiries for futures, and in options also we would have different strikes, call options, put options, and again a dimension of expiries as well. So for a given product, there will be hundreds and even thousands of contracts available. So when we aggregate the positions to arrive at the overall open interest, it is very important to look at how what is the nature of positions that investors have taken in the same product across different contracts. So today we continue to provide the open interest, where we simply add all the open positions, longs and shorts. They are of course equal, and this number is published as open interest. So it does not give a flavor of what is the type of directionality of customer positions in these in this product.
Correct.
So I have given a simple example. So here there's no options, only futures. So let's say that there are two contracts, a current month futures contract and a next month futures contract. So I have given three scenarios on this slide. So first scenario that you would see is that there are only two clients, A and B, and both have done a calendar spread. So calendar client A has a long future in the current month and a short future in the next month, while the client B has a short future in the current month and long future in the next month. So this is one possible scenario. The other possible scenario is where the client B has a calendar spread, short in the current month, long in next month, and the counterparty does not have a calendar spread. So there is client A who is long in current month and client C who is long in the next month. And let us look at the third possible scenario, where all these positions are of different clients. So A and B have long and short position in the current month, and C and D have long and short position in the next month future. So the way we disseminate open interest today, the position in each contract is one. So the contract open interest in each of these contracts in all the three scenarios is one. And therefore, if we look at the total, so this can be a stock or an index, but if we look at the total open interest for this underlying, it will be 2 for all the three cases. So regardless of whether it is the positions are at scenario 1 or 2 or 3, the open interest that we will publish will be equal to 2 always.
Correct.
But if we look at really this how these positions are, we will see that the directionality or price risk is different. So for example, if we look at the first contract, A as well as B have a hedged calendar spread position. So they both of them will their profit and losses will not suffer so much from price movement, only basis the difference between current and next month prices is what will determine their P&Ls. But otherwise, there is no directionality. Even if the market goes up, one contract for both of the clients in this situation will have profit on one contract and loss on one contract, regardless of direction of the movement. So this there is no both of them don't have a directional view on the market. They have a basis. So if you see the second situation, uh, that there is in both contracts there is one person who has taken a directional view. So in the first contract, client A has a directional view, and in the next contract, client C has a directional view. But no, the client B does not have a directional view as a spread positions. Whereas if we look at the third situation, in both contracts there are two people who have taken directional views in the contract A also and contract B also. So now when we publish two kinds of delta equivalent open interest, a contract wise open interest, which is something that even the participants can calculate, but we also publish a more useful metric called portfolio wise open interest. So which takes into consideration this directionality of positions. So if in our in the first uh, in the first scenario, because they're both these customers have taken a hedge position, the directionality will be zero, and the delta OI will be delta equivalent OI will be zero. In the second situation, because there is no one person in each contract having a view, so delta equivalent open interest will be one. And in the third scenario, because there is no hedged positions, there are all naked positions by four different people, and no, so the delta hedged open interest in this scenario will be 2. So this is how. So we continue to publish the open interest we have been doing for many years. In addition to publication of the regular open interest, we also have started publishing this delta equivalent open interest. So this metric will give more insight to the market at large, saying that given this no open interest gives us what is the gross open position in the market.
Correct.
But in addition to that gross open interest, what is the degree of the directional positions? How many positions are directional? How many are hedged? That kind of idea one would get if one looks at delta equivalent open interest in addition to the regular open interest.
Correct. And I believe this we provide for every symbol, right?
Yes, we provide this for every single stock as well as index.
Okay, great. So thank you very much. Thank you for providing the initial brief. Now, if we can understand more about delta equivalent open interest, preferably with an illustrative example for the contract wise.
Yeah, so you're correct. Thank you. So like I mentioned, there are two types of delta equivalent open interest that we publish. One is based on contract and one is based on portfolio. So here I have taken example where there are four clients, C1, C2, C3, and C4. And in this, suppose this thing works same if for stocks as well as for indices. Here I have taken an example of a stock. So suppose there are three contracts. One is a future of stock A. The second is a call option for 2000 strike of stock A, which is an ATM contract and has a delta of 0.5. And the third contract is a put option of call stock A, which is an out of the money option, and it has a delta of minus 0.1. For futures, the delta is taken as 1. So client 1 has a position in stock future, a short position in stock future and a long position in the call. Client 2 has again short position in future and long position in put here. And then again client 3 and client 4 both, client 3 has a long position in call and short in put, and client 4 has a long position in future and a short position in the call. So what we do is to calculate the contract wise open interest, we take the open interest of each contract as we do today. So today when we publish the, let's say, stock A future open interest, we would aggregate the longs and shorts. So if we see here, C1 and C2 have minus 10 and minus 40, so total short is minus 50, and C4 has a plus 50 position in cost of the future. So the 50 minus 50, of course, we'll have a matched book, and the stock A future open interest is 50. Similarly, the call options open interest is 80. which is on account of 50 of C1 and 30 of C3, making plus 80, and minus 80 of C4. Similarly, for the put option, the open interest is 10. So we take this open interest and we multiply it by absolute value of the delta. So future 50 becomes equivalent 50 in terms of delta. 80 call option becomes 40 in terms of delta because the delta is 0.5. So 80 into 0.5 gives 40. And we take absolute value of the delta. So minus 0.1 delta here in this example multiplied by 10 becomes 1. So the total open interest in terms of contract wise OI is 91. So if we today, no, historically we have been publishing this number of 140, which kind of weighs all the contracts in the same way. But now we would know that uh, because there are positions in OTM options which actually have a very small delta, the number can be lower than the open interest that is published, that is the regular open interest. So in this example, regular open interest is 140, but contract wise open interest is 91. So this is the first way of calculating, which is the contract wise.
Okay. So as you were mentioning, this will be absolute aggregation at the underlying level, right? As you have explained in the example, for open interest in normal way, 140 is coming, wherein delta OI contract level, it will be 91.
Correct.
Okay, great. That was an apt explanation, members. We hope that you have understood for the contract wise calculation. So as you were mentioning, there is a portfolio wise calculation as well. So if we can explain to the participants for the portfolio wise calculations also.
Yeah, sure. So I think actually participants will find more value in the portfolio wise calculation because no, of course, market participants using they can calculate delta on their own, and using the delta they can calculate the contract wise delta equivalent open interest on their own as well. But this is an additional information which only the CC can calculate and provide, which is what is the net delta at a customer level. So we calculate the net delta at client level, and then we, of course, when we aggregate longs and short deltas, we will get a match book, and this is what we publish. So let me illustrate again. So the example and the positions of C1, C2, C3, C4 are the same. They as the previous example. So here for client A, if we see, so now what we were doing in contract wise open interest was we were aggregating the positions at the level of contract and then multiplying by delta to get the delta equivalent open interest. But in the portfolio wise calculation, we calculate the net delta for each of the clients separately. So let us take this client one's example. So we have a stock future minus 10 position and call 50 position. So in delta equivalent terms, minus 10 remains minus 10 because futures delta is 1, and stock a call, because it has a 0.5 delta, the 50 position becomes a delta equivalent position of 25. And here we are using the signs. We are not taking absolute values. So minus 10 plus 25 means 15 delta is the position of client C1.
So it will be netting.
That will be netting.
Okay.
So we'll net off within the same client to
Correct.
arrive at what is the net delta for that client. If we look at C2, minus 40 stock futures 1:1, and again here we are not taking absolute delta. So 10 long position in put becomes minus 1 delta because put delta is negative minus 0.1, so it becomes minus 1 delta. C2's overall position is minus 41. Similarly, C3, if we see 30 into 0.5, 15, minus 10 into minus 0.1 becomes plus 1. So 15 plus delta for stock A call, and 1 plus delta for short position input. Total delta in delta terms, C3's position is 16. And for C4, 50 future becomes 50, and minus 80 call multiplied by 0.5 delta becomes minus 40. So here the net delta of C4 is 10. So now if we see, there are three clients, C1, C3, and C4, which have a positive delta position, and one client C2, which has a negative delta position. So if we add up the long delta positions, which is 15 plus 16 plus 10, it will become 41. Similarly, if we add the uh, short positions also, there is only one client in this case, C2. So C2's position is minus 41. Always the long delta equivalent positions and short not delta equivalent positions will be 41. So the delta equivalent open interest in portfolio terms is 41.
Okay.
So there is an error on the slide, so it should be 41, not 39.
Okay, so participants, please keep in mind there is a typo wherein you can find 39. Actually, it is a 41 delta OI at the portfolio level. So accordingly, understand this example. Please go ahead, Aniket.
Yeah. So that is what the third number that we publish. So in addition to the regular open interest, we publish the contract-wise open interest and the portfolio open interest. So if you recall the earlier example, we had 140 as the notional or the regular open interest for this stock based on all the three contracts. The contract-wise portfolio, contract-wise delta equivalent open interest is 91, and the portfolio wise open interest is 41. So all these three numbers is what we publish on a end of day basis on a every day. So this file is published every day, and if one can look at this file in our website in the report section. You should go to the report section and choose the derivatives tab, and the name of this report is combined delta equivalent open interest across exchanges. It's a CSV file, and what we also do is that this data is combined across the two CCs, NCL and ICCL. So similar to the way we compute combined open interest for MWPL monitoring, which is done by sharing data between CCs, we also share the data of delta equivalent positions, and this is also on a combined basis across exchanges and CCs.
Correct. And if I'm not mistaken, Aniket, this file provides all the three columns all together besides the respective symbol. So participants, you'll get the respective symbol. After that, there will be a normal OI as per the calculation done, which will be provided. The next column will be the contract level OI, which will be provided, which is called delta equivalent OI at the contract level. And the last column in this particular daily file will be portfolio level delta equivalent OI. So this will give you a side-by-side view of all the OI, for which right now we have understood at length through different examples and different scenario, which Aniket has clearly tried to explain. But again, just to reiterate what Aniket has said, for benefit of all the participants, there are different applicability in the calculation methodology for the contract level and portfolio level OI, right, Aniket? So member has to keep in mind while referring respective figure so that they are not confused or they are not mistaken, right? So great. Thank you, Aniket. Any concluding remarks that you'd like to give related to summarizing our today's discussion?
Yes. So like I said in the beginning, open interest is a useful metric to see what kind of exposure is there in the market, what is the degree of positions that people have taken. And historically, we have been publishing a regular open interest for many years now. But now that our market has developed, and for a given contract, it's for a given product, it's not that only one contract is active. There are no tens and hundreds of contracts that are active. Okay. So it makes sense to aggregate the contract-wise open interest in a logical manner, which is done in the contract-wise open interest. And in fact, because even customers don't trade only one contract, but customers also trade strategies. They do different kind of portfolios. So it makes sense to see what is the net delta equivalent position at customer level and aggregate that at market level to give a sense of what is the real kind of risk exposure, or what is the kind of effective positions, if I could use that word, in the market. So that is what portfolio delta equivalent open interest does. And this is a useful disclosure that the way that people study for whatever purposes people are studying open interest, they can also look at, in addition to open interest, also look at the portfolio equivalent delta OI and contract level delta OI, which I suppose will be a very useful new disclosure that we have started giving since last few months.
Correct. Thank you, Aniket. So participants, we wanted to bring awareness among you and other market participants through this brief yet crisp and clear open house webinar on a specific topic of delta equivalent open interest. We are open to do more such sessions. As you are aware, you can definitely suggest more topics through your respective regional RM or our head office team, and we'll be glad to do more and more such open house webinars subsequent to this as well. With this, we conclude today's session. Have a great day ahead. And again, thank you. Thank you very much for joining in.
Thank you.
Thank you.